Hi, good evening, everyone. We will be starting the webinar now. So, firstly, a warm welcome to our audience. Thank you for joining us this evening. Our topic for today, obviously, is the mid-year market review. Allow me to introduce myself. My name is Sharon Sung. I'm the MD and Head of Commercial at SDAX. SDAX is a globally connected, integrated digital financial services platform focused on the private markets. We are regulated and licensed by the MAS in Singapore with both a CMS and RMO license. And our exchange platform offers access to exclusive investments from within its ecosystem and secondary market trading via its digital asset exchange. Our investment opportunities include private credits, equities, funds, real estate, and alternatives, which have undergone SDAX's rigorous due diligence process. We aim to connect markets through partnerships covering North America, the UK, Europe, and the Asia-Pacific region to deliver a seamless and efficient cross-border digital asset ecosystem. We are supported by shareholders with an established track record in their respective fields, including ESR, the largest real estate manager in APAC, PSA International, Singapore's leading port group, the Straits Trading Company, a renowned Singapore conglomerate investment company, and the multidisciplinary professional services group, the RHT group of companies. With that, as you know, we have a very esteemed panel with us this evening, speakers from OCBC and two very seasoned fund managers with us. I will let them introduce themselves instead of me belaboring their virtues. So Lavanya, please.
Thank you, Sharon, and thank you everyone for joining us. So I'm Lavanya Venkateswaran. I'm the Senior ASEAN Economist at OCBC. I joined OCBC in April of this year, so I'm relatively new, but prior to that, I was with Mizuho Bank and Nomura. I've been covering the Southeast Asia region for over 10 years now, and I've been tracking the economies of Indonesia, Malaysia, Philippines, Thailand, Singapore. And at OCBC, I also look at pan-ASEAN trends. So I'm here to basically give you an update on the macroeconomic events of the past half year and what to look forward to in the next half year.
Thank you, Lavanya. Patrick?
Hi, good evening, everyone. I'm Patrick Chong. I'm the CIO for Golden Hill Asset Management. Just a bit of background myself. I started my career actually in FICC, joining the FX and rates trading desk in Stanchart in 1998. And then I moved on to various roles in Hong Kong and China. Last I was head of China trading, head of markets in China, ING, and then I returned to Singapore, joining UBS, where I ran a team of traders in South Asia risk trading. So with about 15 years of FICC experience, I moved on to the asset management side of the business. Golden Hill Asset Management was originally a single family office. We started in about 2016. Over the years, we evolved into EAM and MFO kind of platform, offering bespoke investment management services across private and public markets.
Thank you, Patrick. Benjamin?
Hi everyone, I'm Benjamin Yong. I'm actually the head of portfolio management for Acore Investments. Basically, my experience in trading for high net worth, ultra high net worth clients in the banks for the last maybe 20 years. Yeah, but out of these 20 years, 15 years was with the private banks. Joined this family office. We are MFO, multi-family office, and we handle portfolios of ultra high and high net worth individuals across all asset classes, including in the private markets. We have our suite of funds as well that I also run. In terms of trading experience, probably around 20 multi-asset. Thanks. Thanks for coming, everyone.
Thanks, Ben. So I think without further ado, I think we'll kick off this webinar. So just a little bit of housekeeping. You will notice that there's a Q&A button at the bottom of your screen on Zoom. So please use that to post any questions that you may have for us, any of the panelists. If you want to address them to a specific panelist, please indicate that in your question. We will only be taking questions at the very end, but please post your questions throughout the webinar and we will address them as we get to the end of the webinar. So let's just dive straight into it. I think what we're all interested to hear is, your views. What were the key events that impacted the markets in the first half of 2023? We'll start this off with Lavanya.
Sure. So I think from my perspective, there were three key events that basically drove markets in the first half of this year. The first one was the banking sector turmoil that we've seen. So in the US, we had regional banks, namely the SPV, which experienced a run, right? And that led to a sort of a spillover effect onto other regional banks, including the Signature Bank and the First Republic Bank. And it basically highlighted the fallout of the rapid tightening cycle by the US Fed onto regional banks. Then translating some of this stress in the banking system across the Atlantic, we also saw long-standing problems in Credit Suisse, basically leading to its merger with UBS, right? So I think this banking sector turmoil was one of the key events of the first half of this year. The second key event was and still is the weakness in the Chinese economy, right? So I think there was a lot of hope and hype at the start of the year when China announced its reopening policies. So there was a lot of expectation there that there would be a huge boost to global growth from the reopening of the Chinese economy. And I think there's been some disappointment on that front, which will continue because not just because of cyclical factors, but also because the Chinese economy is dealing with more underlying issues, right? And finally, I think the third big event has been this return of a hawkish US Fed. So I think at some point in the first half of the year, there was market pricing for the US Fed had turned to rate cuts as early as June or July of this year. And so that's been dramatically repriced. And now the markets have almost fully priced in a hike by the Fed next week, right? So I think there's been this sort of whipsawing in terms of the US Fed expectations, which was quite at the start of the year not expected. So there's been a lot of volatility associated with that. So I think from my perspective, these were the three key sort of events that impacted the market in the first half.
Thanks, Lavanya. Ben, would you like to add to any of those comments?
Yeah, I think what Lavanya said is quite accurate, but the market has been quite volatile in the beginning of the year. After that, I think in March of this year, where the AI story came in and everybody was jumping on the bandwagon to buy the AI stocks. Of course, before that, there was EV stocks as well, and crypto as well. Crypto was also coming down and it stabilized recently. I think in general, what we are seeing here is that the market is looking for direction. All right, they're looking for direction in terms of rotational play, because what Lavanya said, the central bankers themselves are still hawkish, and so it keeps the market jittery. And so what we are seeing right now is that the market is going with the flow, and that's what we're seeing in the US market. And I think there's some diversification from China to the US, that we're seeing there's some divergence in terms of the equities market, including the fixed income as well. So of course, yields going up has generated some liquidity drain from the capital markets, I believe, because right now, if you park cash in the money market funds and so forth, short duration bonds, you can get quite a pretty decent return with not much volatility. So having said that, I think what we have seen for the first quarter, we saw an allocation of the funds going into rotational sectoral play, and as well as divergent cash and focus on more central bankers' opinion. And then the second half is that we're seeing that this has carried on to the AI stocks, which we don't know when the road will end, but I'm quite sure it has gone up quite a bit. Yeah.
Okay. Actually, that leads also us quite nicely to Patrick, because you did make a comment on fixed income and interest rates. Patrick, would you like to add anything?
Yeah, I think on top of what it's been said so far, I think the other big disappointment in the markets was the recovery of the Chinese real estate market. So I think there were, a lot of measures were being pushed out by the Chinese government to try to arrest the demise of the whole sector, particularly the private-owned firms. Things were looking pretty good in quarter one, and then in quarter two, all the sales numbers start coming off quite badly, and then we have more defaults and more distress to the extent that the state-linked companies like Sino-Ocean getting into a lot of trouble, and other names like Greenland just defaulted yesterday. I think that really caught the market by surprise from a credit perspective. I think the other thing that was mentioned earlier on, Credit Suisse, I thought that's probably one of the biggest events this year because, personally, I think what Swiss National Bank did and FEMA is a little bit unconstitutional. I was watching the event unfolding over the weekend, that day, and when UBS purchased CS, that was kind of quite expected, to be honest. But the full write-down of 17 billion of bonds, from my perspective, that's quite shocking. Markets sell off after that, even though they somewhat recovered. But I think structurally that created or dampened the risk appetite for banks' AT1s. And a lot probably need to be seen in the next couple of months or even 1 or 2 years before the risk appetite actually come back.
Yeah, I think that's a space that I think we're all still watching quite closely. I think moving along, let's look at what can we have the next slide? Maybe just a quick recap, right? About what was your house view at the start of 2023, and given some of the events that each of you have now articulated to us, what was the house view at the start of the year, and how did it compare to how the markets performed given these big events that shaped how markets actually moved in the first half? Lavanya, would you like to start us off?
Sure. So I think at the start of the year, the general market feeling was that we were waiting for a recession, right? So we were basically at the foothills of a recession. I think our view at OCBC was that we were a little bit more cautiously optimistic. And that was mostly because of the US economy and the resilience that was being shown in the economy, mostly on the consumer side. Now, we've been proved right in terms of the resilience from the US economy, but I think even the extent of the resilience has surprised us as well. But generally, I think, the growth picture has been one of weakness. And so that's something we had expected at the start of the year. We're seeing it going into the second half of this year as well. There is a certain dichotomy that we're seeing in the growth picture where, there's a weakness in the manufacturing sector, but there's a resilience that's holding up in the services sector across the board, right? And that's something we had sort of anticipated at the start of the year, and it's manifesting as well. In terms of inflation, our baseline scenario was for inflation to start dropping closer to now, which is the midpoint of the year, because of the sharp base effects from last year. So commodity prices, particularly oil prices, peaked around June, July last year. So we were expecting that drop in year-on-year commodity prices to come through in June and July. And we're kind of seeing that on the baseline. But the one thing that we note is that, we've always cautioned that inflation will be a bugbear this year, right? And that's proven to be true because core inflation pressures have remained very sticky. And that, I think, is something that central banks, not just on the developed market side, but even on the emerging market side, are grappling with. Finally, I think where we've been a little surprised is in terms of the continued hawkishness of the US Federal Reserve, right? We had expected that by the middle of this year or going into Q3, there'd be some signs that the tightening cycle is starting to wane or we've reached the end of the tightening cycle. But I think given where market pricing was, the US Fed probably felt it necessary to be more hawkish and to sound even more worried about inflation. And so I think now we're at a stage where they probably will deliver at least another 25 basis point hike, but they might not sound very dovish or as dovish as we had expected. So I think so in terms of the big macro picture, that's basically our baseline has played out to a large extent. But I think where we've been surprised mostly is on the resilience of the US economy, the continued hawkishness of the US Fed. And basically, we actually started thinking that there'd be some divergence that would follow through into emerging markets by the middle of this year. But I think that divergence in terms of EM central banks wanting to cut rates has been pushed out more towards the end of this year or a 2024 story.
Patrick, or would you?
Yeah, from our perspective, we were a little bit more dovish than OCBC in the earlier part of the year. In fact, we had the expectation that Fed inflation will come off, labor markets will weaken, and we initially expected the Fed to pivot in first half of the year, which is round about now. And we also felt that odds of leading to rate cuts down to about 3.5% by end of this year. So like OCBC, we were a bit surprised by the stubbornness of inflation and the labor markets. However, we had the view that there's no need to see a big recession in US to bring down inflation. And so far, the US economy has proven to be very resilient. I think the other thing that we were making quite a strong view on beginning of the year was China. We were very optimistic on the V-shaped recovery. We had expected the recovery to be consumption-led, even though we were a little bit more careful about capex and construction. Obviously, what happened in the last couple of months surprised us quite badly. Youth unemployment 24%, consumption is very poor. We are very surprised, with the absolute lack of confidence from the consumer's perspective. And I think there's a lot of negative wealth effect from the real estate markets as well as the stock market. The other thing that we had a very strong view on was obviously, like I mentioned earlier on, recovery in the real estate sector. That didn't turn out to be true. I think we expected at least the tier 1, tier 2 cities to be a lot more resilient. But looks like, with the huge inventory overhang and, bad news coming out every other month about who is getting into distress. So initially there was a boycott of paying mortgages. I think now there's a boycott of even going to showrooms. So that part really surprised us. Overall, I think the Hong Kong and China markets, down about 15% from the peak that we saw. And, you can also feel that liquidity and participation is kind of diminishing from that markets. Foreigners are obviously getting less involved. Even from a retail perspective, we can feel that investors are, after years of not doing well, are kind of like giving up on this market. So that's something that's a little bit surprising to us.
Interesting. And Ben, would you like to share your views, please?
Yeah, actually, we did a quantitative analysis of the markets since the end of last year, and we were pretty bullish on all asset classes. The reason is because if you do a backtesting, whenever the Fed cut from 50 to 25 basis points, it's not the rate that matters, it's the rate of change. So if the Fed was to cut from 50 to 25, means the rate has decreased. So we became, when the Fed announced that they were cutting from 50 to 25, we became very bullish on the market. Okay, the problem right now is what's going on. For the start of the year, we did pretty well. Whether is it fixed income or equities, but the question that we say in the second half of the year, we are not too clear. So we are performing pretty okay, but like I said, volatility has come down because the market is inverse. The market has gone up. But as long as the CPI numbers in US and around the emerging markets are pretty contained, I think on the average basis, based on our quant analysis, is that usually central bankers, of course, I don't know what's the average in terms of CPI, maybe Lavanya can comment on that. But I noticed that the band over the last 25 years of backtesting is that the bandwidth, at least for the Fed, that they keep the interest rate for the investors out there is around 1.5 to 2.5% of the average CPI numbers that I have that we have quantitatively managed to backtest. So if you want to know where the interest rate is unless we are going to a deflationary process, which we are right now, but how bad is this deflationary process going to go? It's going to affect equities, it's going to affect bonds and everything. But unless we go into a prolonged deflationary process, I believe that rates, right, will hover around, and the markets will hover in the range from this level on. Maybe unless there's positive news coming in, I don't know from where, but positive news, maybe sectorial. The big techs might not be leading this time around, but who knows if the general economy is going to slow down. I don't know where is the impetus to move the markets higher. So I suspect that we probably have a nice trading range coming. And the risk-adjusted returns that what the banks have always been saying right now, it probably might go towards fixed income. Unless you are a market-neutral, strategy-based equities fund that can short the market or long the market or be market-neutral. I think most of the gains this year has been met in terms of equity class from our side. Yeah.
Oh, that's quite interesting. Thank you. We'll move on to I think what would be interesting for us to understand is, what are the other key drivers that are expected to shape the rest of the year, and what are the major risk areas you're monitoring and why?
Sure. So, I mean, from our point of view, I think our house view is now tending towards, a US recession becoming inevitable over the next 12-month period, partly because we're of the view that the Fed is at a risk of making a policy mistake, right, where it over tightens and it precipitates the next slowdown. So we've sort of come to terms with the fact that there will be a recession over the next 12 months. In fact, our growth forecast for US growth next year is actually 0. So we don't expect much growth in that economy. At the same time, I think we're monitoring what's happening in China very closely. As Patrick mentioned, the disappointment in the Chinese property market is something that I think a lot of investors are concerned about. And so recently we saw some measures come out from the government of China in terms of trying to stimulate that sector. But it's so far been in bits and bobs, right? So we're trying to see if the government will announce more significant measures to try and prop up the economy. And I guess one key event in that area is basically the July Politburo meeting, which should be around the end of this month. Then I think the other thing that we as a house view is that geopolitical risks are basically here to stay. They have not abated as a lot of people expected at the start of this year. So things like, the Russia-Ukraine tensions will stay. And while US-China relations wax and wane, depending on the sort of warmth of relationships, we do think that there is an underlying stress there. And recently, the relationship has become warmer because of the meetings between high-level officials. But generally, there is a stress underlying that's coming through in both these areas, right? Finally, I think I think both Ben and Patrick have mentioned that risk appetite over the last 6 months, that means the start of this year, since the start of this year, has actually been relatively constructive, even though it has been choppy, right? So for certain economies, especially like the ASEAN economies, we're a little bit more on the positive side. So we're looking at this as more of a half glass full story rather than a completely dull story, right? So for these economies, we actually think that the domestic sector will hold up quite well, even if export growth is slowing. So that's basically our broad-based outlook for the second half of this year, and those are the kind of things that we're monitoring.
Okay, great, thank you. Ben, what are the risk areas you're monitoring?
Well, the risk areas right now is that now that certain sectors of the markets are in exuberance level right now, euphoria, the bandwagon will end sooner or later in terms of the tech stocks, the big cap techs, because the projection earnings are just mind-boggling. I think it's just a race between Apple and Microsoft to hit it in 3 trillion. I think Apple just hit it yesterday. But anyway, what I'm saying here is that the future, the prospects of the market going forward is investors need to ask themselves. The last 2 years across all asset classes, I hardly, even with the US markets at this level, don't talk about the Chinese markets. I'm sure everybody's losing money. If you're talking about the US, you're barely breaking even. Whether you're in emerging market bond fund, you're in US treasuries, you're in investment grade bonds, and even for the US market equities, you're barely breaking even, maybe up 3-4% from the peak 2 years ago. You just do, and that for those investors who just started investing, the question right now is, where is the risk-adjusted return? And keep in mind, cash is around 4%, 4.5%. If you know where to find short duration bonds, maybe even 5, 7, you can even get some 781 bonds or even some BBB bonds, US dollar, right? So going from this point, right, actually you do have options. What I feel is that the risk is anybody's guess, because one day war can break out, the other day, next day, some central banker might be saying, I'm going to cut rates. We don't know. At the end of the day, CPI numbers, there's a lot of factors involved. But one thing we know for sure, and that is that consumers spending, their cash flow, household spending is going to be constricted in the next year of loan reset, right? Loans are going up, okay? Unless we have a full deflationary cycle that is coming, right? In terms of the central bankers' numbers, but this will be down the road 6 months to 12 months. Right? Consumers' confidence in terms of their household spending should come down. Whether the US is robust or not, it's going to happen. Recently just come out, the student loans have been reactivated, right? So we know that consumers, I don't know how long they can hold out. Everybody has taken a lot of loans last 10, 15 years, including Singaporeans, all around the world. All right, we can see that on the commercial property side, it's having problems. Right? Whether it's in China, whether it's in New Zealand, whether it's in US, right? Funds that are covering commercial properties are having big problems right now, whether they want to restructure their loans in terms of the institutional side. For our side, we see a lot of problems coming up, but the central bankers do not have the tools to handle this. All right, I repeat that. The central bankers only have their monetary tools. But the true driver of the US economy and globally, including China, is the consumers. If you see the makeup of China and US, right, most of them, right, are consumer driven right now. All right, and that is going to be the test bed for the next half year. Numbers are coming through. Netflix, Tesla just came out. Disappointing numbers. Why? Because the market ran up too fast ahead of earnings. Markets tend to overthrow. And that's where volatility trading comes in, where we take advantage of this trading. So I'm seeing volatility will rise because it's been low for too long. Two market rules to share with the investors. First thing is, don't try to chase a crowded trade. for too long. Okay, you'll never make money. Don't be the last man standing. Second is that volatility always goes from low to high. As traders, as investors, and fund managers, we all know that. These are two market rules that I can share with investors. Do not chase. If you want to chase at this one, we need to allocate the portfolio. Portfolio allocation is key. So my thing is that you have cash that pays you 4.5. We'll talk about this later, I'm sure. But second half is going to be a challenging decision for investors. The first half, money has been made. And if you have missed out on the boat, don't worry, you still got 4.5. 5, maybe if interest rate spikes again, goes up again this July, 100% based on futures, that it's going to be another 25 basis point hike for the US. Whether the emerging markets can take another hike, I thought so. So maybe that's why people are talking about emerging market bonds now being bullish. And I see the prices of emerging market bonds going higher, US dollar based. So I think that maybe the emerging market side might be, if you want more returns, but of course there's risk. The second half of the year is risk-adjusted return, all right? And you keep in mind your risk-free rate is 4.5, 5% if you can get it. I think Sing dollar Singapore is about 3.8 now. I think you just did a closure today, Sing dollar. So that's your minimum return. If you don't want to take risk, just allocate in terms of your portfolio. We'll talk about that later. Thanks.
Thanks, Ben. Patrick, would you like to add about this discussion on risk?
Yeah, I think I agree with both of them that one of the biggest risks that the Fed has been too hawkish. So, I think Ben made a very good point about risk-adjusted returns. As US markets trading at forward PE 22, 23 times, it makes it kind of very vulnerable to collapse quite quickly when things do go bad. However, we don't see a deep recession coming in US. But then again, markets are expensive right now. So that makes it quite easy to come off quite quickly, to be honest. Obviously, the other thing is that we all know that, on an equal weighted basis, the markets actually did not do so well. It's really been carried out by the likes of Nvidia, Microsoft, Tesla, you name it. And the moves this year has been quite crazy. So any corrective moves on the downside can exert a lot of pain on the markets. Other than that, we are a bit more concerned about Eurozone and UK. I think in terms of fighting the inflation, they seem to be not getting the job done quite well. Well, good thing is UK inflation came in slightly softer yesterday, so that's a bit of a relief. But we are seeing certain sectors like utilities and obviously commercial real estate getting a little bit of pressure. The question is whether it gets bad enough to spread to the wider economy, to the financial market, to the financial institutions. So that's something that we are watching quite closely. And obviously, I think the last thing that we are most concerned about, policy misstep by China again. There was a supposedly supposed to be some kind of a state council briefing today at 3 p.m. Everybody was looking for it, but nothing happened. So this became a bit of a recurring theme where investors are watching for the Chinese government to announce new measures and stuff like that. But what they announced in the last couple of days, in fact, yesterday they talked about encouraging consumption and all that. It's really like all talk, no action, if you ask me. So that's one big risk factor that we think that the Chinese government, the policymakers, they potentially could underestimate the impact of what they are not doing. And China is, after all, the world's second largest economy, right? And if we look at the trade numbers that just came out last week, I think it's awful. So I think if China gets into a really slow growth environment, then for the global markets as a whole, I think the impact will be quite big. And finally, I think the part about falls being too low right now, also a very good point. We have our own internally created sort of like a risk index that we look at multiple variables. In the last couple of weeks, our index is showing at a level that the level of complacency in the market is something that I haven't seen for the last 1 year, really low. So correctly pointed out, vols, when they are so low, there's only one way you can go, you can only go up. So I think in terms of complacency, particularly in the US markets, I think markets are too complacent right now. And reiterating what I said earlier on with valuations where they are today, if it doesn't take a lot for market to just come off, some bad news being triggered, I think the downside potential can be quite big. So our position is that for investors who have, if you happen to have Nvidia, Tesla, Microsoft, Meta, the big tech names that have done well, probably it's a good idea to lock in the gains right now, because I don't hard to see the trigger for the next 20-30% in some of these single names from here.
Okay. Well, okay, thanks, Patrick. We've actually talked quite a bit about China already, but we do want to still understand, what is your baseline outlook on China. We know we've heard some of the risk issues, especially those associated with the property market, but I think it's still useful, if you can just give us a general comment on what is your outlook on China, Lavanya.
Sure. So we expect weaker growth in China. I think that's pretty clear for the next 1.5 years, right? So the weakness is twofold, as Patrick has mentioned before. So one is the property market, but the other is also strained household balance sheets, right? So after the pandemic, I think households in China are still rebuilding their balance sheets. So their ability to actually spend on retail, which Benjamin mentioned was a huge driver of growth, which is very true, is actually going to be lower now. So at some point we are questioning if Chinese households are actually at this balance sheet recession risk, which means that any additional income is actually going to be used to replenish their household balance sheet rather than be used to boost overall consumption, right? So I think that's a risk that we're watching very closely, and that's something that we've taken into account in our baseline to some extent. The other problem will kind of sort itself out when the cyclical cycle turns, which is manufacturing overcapacity right now. So there's a lot of overcapacity in the manufacturing sector. Capacity utilization, although it's picked up in recent months, is still lower than it was in pre-pandemic levels. And so this is largely reflective of the weaker global demand that we're seeing, right? So this will sort itself out as global demand picks up. But this cycle of global demand picking up is still, I think, not even a 2024 story. It's beyond 2024 at this point. So so I think these are the kind of three factors that are driving Chinese growth lower, right? There is also a structural story which I just put out here because there are also fundamental supply chain adjustments that are happening across the region, right? Where manufacturing is being diversified into China +1 countries. And in that context, the ASEAN countries benefit a lot. So there is also a case to be made that, there will be some overall diversification of manufacturing across the region, right? And finally, I guess geopolitics on China, and like we just mentioned, although US-China relationship has thawed in recent weeks, there is a sort of underlying stress there that we'll monitor, which will also be a drag on growth, right? So that's basically our outlook. But I guess the caveat from our side is that we're still above consensus when it comes to the growth forecast. So we're still more optimistic than everybody else, but the trajectory is of a slowdown.
Fair point. Patrick, would you like to add to that?
Yeah, I think it is quite clear that China is in a bad place right now. So the question is whether the asset prices are fully pricing in the kind of slowdown that market is anticipating. So from my perspective, if you look at the Chinese markets trading at 11-12 times PE. Hang Seng is about 12. Hang Seng is really largely China, right? My take is that a lot of the bad news has been pretty much priced in. if we look at how the China big techs underperform, US big tech, you look at where the surviving real estate firms are trading at now, that all of them are trading at 0.1 book value, right? I think from a risk adjusted perspective, I think the downside for the Chinese markets, including Hong Kong, probably quite limited. So from a risk reward perspective, even though we are fully in agreement that the China economy is not doing so well, and added the fact that the authorities don't seem to be very keen in stimulating the economy in a big way like they did previously. I think from a valuation perspective, we prefer to be invested in China right now, basically staying invested. And few areas of opportunities, I think, will probably come out in the next few months. Obviously, consumption-led recovery, we would like to play that on the e-commerce, China big tech kind of angle. Potentially, even if you look at, I kept talking about real estate because that sector is just doing so badly. If you look at the valuation of those surviving companies right now, I think the risk reward favors, maybe from a percentage point of view, a small allocation to some of these names, because China's urbanization is just something like 64%, 65%. It's a big country. There's still a lot of urbanization to do, even though inventory is a problem right now. But I think we're still going to need developers to fill the gap and build houses in the next 5-10 years. Obviously, you can't expect the SOEs to be the only one doing that. So there will be some surviving POEs. So I think that's an opportunity as well. But that said, we are also cognizant about the local government debt problem, the LGFVs. So I think this is something that's been talked about a lot recently as well. The north western provinces, the Yunnan, the Guizhou, and all that. So I think something needs to be done. I believe that the government is looking at this situation. I think they do not want to be seen bailing out the LGFVs for taking on too much leverage. But I think we will probably see a bigger role from the AMCs in terms of helping with the asset disposal that these LGFVs need to do. My position is that quite a few other investors are very concerned about LGFV crisis alongside with the CRE crisis blowing up into something really big and systemic in China. I personally think that a lot of the bad news has been priced in. And so, yeah, from a risk-reward perspective, it kind of makes sense to stay invested in China, at least vis-a-vis the US markets.
Okay, so I'm hearing sell US tech if you have it, go long China selectively though.
Yeah, but if you don't have it, don't short US, because I think shorting the US is always a pain trade. Over the years, it's proven to be so.
Okay. I think audience always likes to hear very specific views, but let's hear from Ben. Ben, would you like to weigh in?
I just want to comment that US is always trading at a higher valuation for a very clear reason, because capital flows to US is not constricted like China. There's a huge discount in China for a reason, because it is a central government, and the direction that the central government gives right now is anybody's guess. Of course, you can say one thing this and one thing that. That's what happened in the last year. So investors have decided to discount the market. So in my view, China, if I was to invest for my clients, I would consider the more international names. And if I was to buy bonds, I'll just buy an Asia bond fund or something like that I can diversify out the credit risk. I'm not so interested in taking any credit risk in China, personally. So if I was an investor right now, I'll diversify my Chinese risk into sectorial. If one bond goes, I know it's probably exposed 2%, 3%. I still get my payout. Over time, I'll still recover. And whatever the Chinese government does is anybody's guess. Whether is it Taiwan, Consumer side has been affected in China, and that's for sure. Why US is trading at a higher valuation is because the consumers are still spending. When Chinese side, right, like what Patrick has said, they are affected psychologically. They might have money, but savings will go up, they start paying down their loans. It doesn't go into the economy. So we're going to see that, and that could be a deflationary cycle in China. And that's why it's trading at a discount. The market is pricing that in. For me, logically, I'll just think about buying the international name like Baba, good cash flow, haven't paid dividend. I'm waiting for them to pay dividend. I think if they announce it, right, it's going to fly. And of course, they paid their fine. Of course, there are some stories in terms of this, and they are also weighted in the index, Hang Seng, as well as the HSCI. You can just buy the index if you don't want to face all these problems. So let's talk about the Hang Seng index, for example. It's an international index, no capital flow problem at least. So let's just talk about the Hang Seng for me. Rather than the Chinese market, I feel there's some risk there in terms of the capital flows. So for me, the Hang Seng has to cross at least the 20,000 level for me to even trigger a thought to put some money to action, personally, right? Because the market is willing to buy. At the end of the day, we can talk about all the direction, but it's a demand and supply market. In order to make money, right, we need the market to go up. Unless you can short the market down, and it's not so easy to do that. We know as fund managers, right? It's not so easy, especially the Hong Kong market and the Chinese market. Liquidity flow is also news driven in China. So it's not so much fundamentals sometimes, I guess. Of course, in terms of the property sector, right? Whenever the confidence, Chinese people really believe in properties, just like us Singaporeans. Okay. And now that the sentiments on the ground has been affected, I think there's a major indigestion going on in the Chinese economy. Okay, for the consumers to start spending. If we were to see that the Chinese people are paying down their loans and the savings rates goes up, there is a deflationary cycle, personally, I see coming. All right, and the Chinese government has to give the people confidence. They need to set a clearer confidence, not just the investors. The investors buy what the people buy for a consumer-driven economy. So for me, I'll just buy the international names where the revenue comes from around the world for the Chinese. Not so specific in terms of the names or locally earned kind of companies. Maybe that even a BYD, Neo, Xiaomi, and all this. Maybe I'll take a look at all those. If not, I'll take a look at the index. So that's my 2 cents view. If the Chinese bonds, for me, in terms of that, I'm not turning bearish on China. In fact, I agree with Patrick. There is value in China. There is value in China. But there's so many people who have lost money buying the Chinese market that if you were to tell them to average down, right? People are just waiting for the recovery. And trust me, even if the Chinese go up without buying interest coming in, everybody will be selling out of China and moving the money somewhere else. If the Chinese government doesn't give the market confidence that it has changed its direction, it's really open and so forth. And in my view, it will take some time. So I think there will probably be a range-bound trading. Maybe if there's some AI, even when they announce AI, I think on Baidu, look at the stock, it didn't even move, right? So I think it's more of an investor's confidence as well as a consumer confidence that the Chinese market has stagnated, in my view. It's more of a demand supply. There's nothing wrong. Valuations are low for a reason. Confidence is just not there. Thanks.
Okay. In the interest of time, I think we've heard quite a lot from our panelists. We only have another 10 minutes or so of their time, so I would actually propose that we skip straight to the Q&A because there is some quite interesting questions from the audience. So they're clearly very interested to hear from you. So can we just maybe quickly go to the question on Japan? I think the question here is, what are your views on maybe Japan? So maybe just very quickly so that we can take on at least 2 other questions after this one. Lavanya, do you want to kick off on that?
Yeah, sure. So I think our views on Japan are basically that so in terms of the Japanese monetary policy, we're basically expecting that there'll be some tweak in the YCC this year, before the end of this year. However, I think recently we've not, we expected that the July meeting could be a live meeting, but we recently got, looking at, central bank headlines, and that's probably not the case. So yeah, essentially, I think the Japanese economy is basically in a place where Japanese monetary policy is basically in a place where inflation is going up, and then there are the yield differentials between US and Japan are becoming very wide, and so there is sort of talk of a tweak and a longer term readjustment by the BOJ. So I think that's basically the sort of the highlight for us when we're looking at Japan for this year.
We've got, thank you, Lavanya. We've got a question on the US earnings being quite decent so far, and the US big banks are doing well. What would be a reason for the recession, in view that there are huge fiscal, stimulus for infra, chips, and reshoring of manufacturing? Patrick or Ben, would you like to take a stab at this first?
Well, I don't see a US deep recession coming, to be honest. So yeah.
Okay, Ben?
I think US might have a mild recession, very mild. That's the worst case scenario also. At least we have a scenario basis. So worst case scenario will be a mild case recession. In terms of that, yeah. And then the Fed might step in also, I guess. So probably very short-lived. So in terms of the US earnings, back to the question, is quite decent. I don't know, the earnings just started. I don't think it's pretty decent. I think it just met some expectations and missed some expectations. It's pretty average. It's not decent at all.
A mixed bag at the moment, I believe.
Right. It's just the starting of the US reporting season.
Still early in the season.
And for the banks, right, in terms of the banks, the big banks, I think they're pretty average. It's not fantastic results. So I do not agree that it's decent. In fact, we're looking at the banks being margin compressed, as well as managing their bad loans as well. With this opportunity, I think going forward, the banks will have some challenges going on. This could be a low base as well. So I don't think we are seeing much of a decent. I think it's a pretty average, and expectations are high right now. Because at the end of the day, the US banks are the actual barometer of the US consumers to some extent. Yeah, so we're watching this closely as well. Okay. It's not been running the US banks much.
Yeah, thank you. I think I will try and squeeze in this last question. And sort of a combination of two questions. I think essentially what the audience wants to hear is, thoughts on asset allocation for second half. And, associated with that is, are there any specific sectors or region that provides interesting opportunities, or, should more caution be practiced? So I think we can sort of take that, in combination. Maybe, Patrick, do you want to start off?
Yep, sure. So we like bonds right now. Simple reason, rates are not going to stay high forever. So we encourage investors to extend duration, investment grade bonds. Within bonds, we like AT1s. I kind of mentioned it earlier on. I think a lot of the names got punished for no reasons. Names like, if I can mention names like Hong Kong Bank, Perks are good, Lloyds are interesting to us, Julius Baer, AT1s, all these are interesting to us. Finally, for the investors with a deep risk appetite, I think you can take a very small amount of money, put it in some of the Chinese real estate bonds that have not defaulted. Those guys are trading at like 10 cents, 10, 15 cents. So your risk reward is obviously potentially 8x, 10x versus 10 cents. So from a pure risk reward perspective, some of the surviving names, I think that's potentially quite a good tactical trade. And obviously, we are constructive China equity markets. So I think the key question now is, if you are already invested in China and you lost some money in the last few years, should you cut? Our response is no, you should not cut. for investors who have never been invested in China and so they avoided losing money, I think it's probably quite a good level to start picking up some of these better names like what Ben said, like the likes of Alibaba, JD, Meituan, Baidu, etc., and BYD.
Ben?
Okay, this is a very long topic. I try to shorten this, okay? If you don't know what to buy in China, you don't know what bonds to buy. I say you just buy the fund that diversifies your risk in that sector or that country, all right? Use that as your benchmark and then build your portfolio from there. If you have lost money from all these stocks, then if you see the index, the market going up like in China, buy the index and average it down. Do not try to pick stocks. Do not try to average down your stocks because of the Chinese government come out something, gone. All right. So I'm not saying that it's still a minefield, a landmine out there in China. I think Patrick has already emphasized all the news coming out. Nobody knows for sure what is going to happen. China, Taiwan war, whatever. I really don't know. But diversification is key. If you want, right, in terms of that, of course, you can pick some bonds. If this is my portfolio, I'll pick a market neutral fund as well, right? Or maybe park into cash that has to beat the 4.5%, I say, or 5% that returns that you have, all right? If not, put in cash, all right? For opportunities, anything that comes down 20% for the year, 30%, reflect you out on the index side, start accumulating if you don't think that that market will die. Alibaba can still die, BYD can still die, the index usually never dies. All right. And in the long term, right, I think you will see a compounded return. All right. If you can find a fund with an underlying strategy that invests with a market neutral bias on a compounding, very risk-adjusted return that can compound your returns. In other words, the returns are steady apart from bonds. Even bonds are a big question mark now. First things first, you buy that fund as an allocation, and when something comes down, you take out from this fund and reallocate into the index that you want, whether you want to average down your equity funds or something like that. But keep in mind, if you don't want to do, you still expect a 4.5% return or 3.8, depending on the currency you are facing. All right. If you're not sure whether you should average down, don't do it. Just buy the index or buy some other funds with. Even the Temasek is doing dynamic allocation right now. I don't see why individual investors do not look through their portfolio and try. We are not gamblers. We are long-term investors. You can always gamble, allocate 20% of your portfolio if you are still there to play, whether it's crypto, whether it's Baba, whether it's Microsoft, or whatever stocks that you can play momentum. Okay, momentum. In other words, the stock goes up, you hit your target rate, you get out, you reallocate back into your 4.5, 3.8%. and rotate. This year, second half of the year, I recommend clients to do that. And please find a good risk-adjusted return fund that gives you a very steady return apart from money market with a slight, volatility, maybe apart from bonds as well. Yeah, I will recommend clients to do that and watch the market. Because if volatility picks up, I'm sure you have opportunities. It's whether you dare to buy.
Okay, thanks. Thank you. I will take one very last question only because I'm very self-serving at this point. The question was, are you able to share views on crypto? So I'm going to say that we are actually going to run a crypto-related webinar next month called Unveiling the Next Chapter on Crypto on August 22nd. So whoever asked that question in the audience, if you're still interested, please watch out for that. August 22nd, mark your diaries. We'll be running another webinar with a similar format and panelist discussion. So with that, we've just 2 minutes over the hour. It leaves me to thank our panelists, Lavanya, Ben, Patrick, thank you so much for spending your time with us. I think the audience has been very appreciative of all the insights and views that you shared tonight. So with that, I thank you, and we will be ending the webinar here. Thank you, everyone, and have a good evening.
Thank you.
Thank you.
Please remember to do the poll at the end of this that will be popping up on your screen. Thank you.